Howdy, everybody. Welcome to Liberty Call. Today it's Friday, November 1st, 2024. Hope you're having a fantastical day out there in the interwebs. Beautiful day here in Colorado. A little chillier than early in the week, but not too bad. So, hope you're having a great day. Before we jump into the numbers and the markets for the end of the week, if you, yes, you, right there, could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. All right, looks like my internet's a little slow. Anyways, well, we'll get into it anyways. All right, Dow Jones was up 0.69%, 288 points, closed at 42,051. S&P 500 up 0.43%, 24 points, closed at 5730. NASDAQ up 0.8%, 144 points, closed at 18,239. The VIX was down 4.97% today. It's at 2201. Canada up 0.41%, Brazil down 1.19%, and Mexico down 0.11%. In Europe, Germany was up 0.92%, the UK up 0.83%, France up 0.8%, Netherlands up 1.08%, Spain up 1.46%, Italy up 1.15%, Switzerland up 1.64%, and Portugal up 0.95%. Russian exchanges back in the green today. The MOEX up 0.59%, RTSI up 0.16%. And the Asian markets, looks like they're mostly red. The Nikkei in Japan was down 2.79%, Australia down 0.5%, New Zealand down 0.89%. In China, the Shanghai was down 0.24%, the Shenzhen component down 1.28%, China A50 up 0.83%, DJ Shanghai down 0.45%, Hang Seng up 0.93%, and the Taiwan weighted down 0.18% for the week. All right. Well, let's hop into the markets, or the weekly returns for the market. So let's get to that. Start out with the Dow Jones. All righty. So starting out with Friday last week to today, it was down 0.16% for the Dow, and the S&P 500 it's going to be down 1.24%. The NASDAQ down about 1.44%. The Dow Transports looks like they're going to be up 1.5%, and the Dow Utilities down 2.69%. So that's the worst of the five. So three major indexes down smidge. The Dow Transports was the only one that was really up. So if we could, let's zoom out and take a peek and see how the markets have been doing this year. So we can see here on the Dow, pretty flat the first half of the year, little bit of an uptrend that we kept bouncing off of through August, and then a much more stronger uptrend here in since August 1st. But we did break it if we look here on around the 22nd, so Tuesday of last week, and have been trending down downward. So curious to see if this starts lining up in a downward trend and how long that will be, or if it's going to be sideways. All right, let's zoom out and look at the S&P 500. A little bit more of an uptrend starting out the year. We had one downtrend, started a new uptrend, another downtrend that was short-lived again, and then this current uptrend that we've been in since the 1st of August. Broke that on yesterday, either Thursday or Wednesday or Thursday of this week. We came through this trend line. So again, same thing, wondering if that's going to be a long-term trend or something just short-term. And then also the same thing with the NASDAQ, uptrend to start the year, a short downtrend for about a half a month, another uptrend for several months, another 2 or 3 weeks down, then the current trend we've been in right now, and we broke it yesterday. So those are the markets right now. So very exciting stuff. I know I'm excited about it. All right, let's get into the economic data that came out this week. Starting out with initial jobless claims, they came in at 216,000. Forecast was 229. Previous number was 228. Continuing claims came in at 1.862 million. Forecast was 1.89. Previous number was 1.888. Goods trade balance came in at a negative 108. 0.23 billion. And so a significant jump from last month at a negative 94 billion. So Pretty big jump there, and off the forecast of a contraction of 95. Consumer confidence jumped up to 108.7. Forecast was 99.5. Previous number was 99.2. Housing price index year over year grew at 4.2%. The previous number was 4.7. And on a month over month number, it grew at 0.3. Forecast was 0.1. GDP, we got the first number in for Q3, came in at 2.8%, slightly under the 3% forecast. And the previous quarter, the final number was 3%. So I covered an article midweek, I think it was when the GDP numbers came out on, I think, Wednesday, that if we stripped out all the government spending in there, we probably only have a GDP number of around 2. So about a third of most of the production in the U.S. is government related. So, when the wheels come off the tracks, if you're in a business that your major client is the federal government, you might be in some trouble. U.S. pending home sales month over month grew at 7.4%. Forecast was 1.9. Previous number was 0.6. ADP non-farm employment change grew at 233,000. Forecast was 110. Previous number 159,000. Personal income month over month grew at 0.3%, right on forecast. Previous number was 0.2. Personal spending grew at 0.5%. So we're losing 0.2% in that trade. Forecast was 0.4. Previous number was a 0.3. Non-farm payrolls only grew at 12,000. Forecast was 106. Previous number was 223. Unemployment rate held steady at 4.1, right on forecast, same as last month. The U6 unemployment rate, which I really consider the real unemployment rate, 7.7%, same as last month. And the labor participation rate ticked down to 62.6. Forecast was 62.7. And that's it for all the data for the week. So good stuff. Exciting too. I know. I'm on the edge of my seat. All right, market recap. U.S. stocks climb as Amazon jumps. Soft payrolls cement Fed rate cut bets. So what are the odds that they made the numbers look worse for this week due to the fact that the Fed meeting is next Wednesday and Thursday, so that they would have an excuse to continue to drop rates another 0.25%? I wouldn't put it past them. All right. U.S. stocks climbed on Friday, driven by strong earnings from Amazon and a weaker than expected jobs report that solidified expectations for a Federal Reserve rate cut next week. October's labor data showed the U.S. economy only added 12,000 non-farm jobs, well below the anticipated 106,000, and significantly down from September's revised 223,000. The reduced numbers were attributed to impacts from recent hurricanes and ongoing labor strikes. Given this, analysts widely expect the Fed to proceed with another rate cut at its upcoming meeting, likely 25 basis points, as part of a continued effort to stabilize growth amid economic uncertainty. Macquarie analysts anticipate further rate cuts in both November and December. If we could pause here, and I know I've talked about this a lot with clients, so if you're a client and you're watching this, sorry, we've talked about this in the last few weeks, but if the economy is as strong as everyone in Washington and the talking heads on TV seem to make out, why are we lowering rates? I know I've said this more than once, but usually you lower rates when the economy is starting to wobble or stagger or needs a little goofs to keep it from falling into recession. Well, normally they usually wait till after we're in recession and then they do that sort of stuff. They're always way behind. But if the economy is as strong as they say, why didn't they continue to raise interest rates through last summer, fall, and into this year until the market actually started to or the economy started to wobble a little bit, unemployment rising, consumer spending slowing down. But no, they went ahead and lowered rates. I assume it was to help out their friends on Wall Street. So, all right, jumping back in, tech giants Amazon and Apple were also in the spotlight with quarterly earnings releases. Amazon shares surged over 6% after the company reported an 11% year-over-year revenue increase, surpassing Wall Street forecasts, as it benefited from significant opportunities from generative AI. In contrast, Apple stock dipped over 1% following its cautious revenue forecast for the current quarter, pointing to a low to mid-single-digit growth estimate that missed top Wall Street projections, possibly reflecting concerns ahead of the holiday season. Energy stocks traded near flat as oil majors ExxonMobil and Chevron posted quarterly earnings. Although Chevron met expectations, Exxon's slight revenue miss weighed on its stock. Nonetheless, energy prices remain supported by geopolitical tensions, including reports of potential Iranian military action against Israel, helping to limit losses within the sector. Overall, Amazon's strong earnings, coupled with the weak payroll report, reinforcing a probable Fed rate cut, boosted investor sentiment to close the week on a positive note for U.S. stocks. So the market was strong today simply because the jobs numbers look bad, and that leads to the belief that the Fed is going to continue to lower rates, which is good for growth stocks, but it's not good for inflation. So it's like pick your poison. Alrighty, next up, let's dive into some data. The October employment report. This comes from First Trust. Mr. Robert Stein put this together. So let's see what he had to say. The U.S. job market weakened significantly in October, with non-farm payrolls adding only 12,000 jobs, well below the anticipated 100,000, and marking the smallest gain since early 2019, excluding the COVID-19 impacted 2020. The civilian employment metric, which includes small business startups, saw an even steeper decline, dropping by 380,000 jobs. Hurricane Milton, which disrupted the Southeast during the survey week, likely played a role, as 512,000 workers reportedly missed work due to weather, an unusually high number for October. However, job growth revisions for August and September showed a reduction of 112,000 jobs, mostly in the private sector, suggesting broader economic weakness. A core measure of jobs, excluding government, education, and health services, and leisure and hospitality, fell by 81,000 in October, the worst reading outside of early 2020 since 2010, hinting the weather alone does not explain the slowdown. Despite the weaker jobs numbers, the unemployment rate remained steady at 4.1 due to a decline of 220,000 in the labor force. The Federal Reserve, which meets next week to discuss interest rates, is expected to consider October's wage growth, which rose by 0.4% month over month and 4% year over year, higher than the Fed prefers. While the Fed may discount some of this data due to hurricanes, it's likely to still proceed with a quarter-point rate cut. Total private sector hours worked remained flat in October, but are up 1.2% from last year. While some may view the October report as an anomaly, signs point to a potential downshift beyond just one weather event. Who knows? All righty. I mean, if you can believe the numbers that come out of the government. So, all right. Next up, October ISM Manufacturing Index, also from First Trust. Mr. Nate Gersey put this together. The U.S. manufacturing sector continued to struggle in October with declining activity and employment paired with rising inflation. The ISM Manufacturing Index fell to 46.5, falling short of expectations, with only 5 major industries showing growth while 11 contracted. Manufacturing has been in contraction for nearly 2 years, with new orders and production remaining below 50 since June, reflecting the ongoing economic and political uncertainty voiced by manufacturers. Some companies have managed through weak demand by relying on backlogs from the COVID period. However, the backlog index also slipped further to 42.3, signaling that this cushion may soon expire. Manufacturers are scaling back hiring, with the employment index dropping to a weak 44.4, nearing levels seen during the COVID lockdowns. Analysts believe this sector-wide slump is partly due to the contraction in M2 money supply from early 22 through late last year, which has only moderately rebounded recently. Yeah, because we need an increasing money supply so that the inflation goes back up. Inflation remains a concern as the prices paid index rose to 54.8, its highest since the summer, with 11 industries facing higher costs. While the Federal Reserve may continue to cut rates in upcoming meetings, there's a concern that aggressive rate cuts could drive the M2 money supply higher, potentially reigniting inflation. In other economic data, construction spending edged up 0.1% in September, primarily due to a surge in home building, which offset declines in manufacturing and healthcare projects. All right, so there's still a lot of weakness out there in certain sectors of the economy. So, again, like I've talked with clients, most of the stuff we cover in our meetings is kind of top line, spending, and we don't get into the granular stuff typically. I expect them to watch these daily reports and pick up the information there. So, All right, last up from Zero Hedge, after Halloween, the economy could get spooky. And this comes via shiftgold.com. So let's see what they had to say. The upcoming U.S. presidential election on November 5th, followed by the Federal Reserve meeting to discuss future or further interest rate cuts, presents a critical moment for the U.S. economy. Gold and silver prices are hitting all-time highs, reflecting market uncertainty over potential policy shifts. Markets are anticipating the election outcome, with many favoring Trump's proposed deregulation, corporate tax cuts as a bullish indicator for the economy. In contrast, Kamala Harris's plan to provide financial support for African Americans has sparked constitutional concerns, further fueling market preferences for Trump's economic promises. Yeah, you can't just promise stuff to people based on the color of their skin. That's called racism. You'd think Kamala Harris being, well, she's not really black. Candace Owens proved that over the last few weeks that Kamala lied about her heritage. So, if you're voting for her just because she's black, that's, it's kind of like voting for Barack because he's black. We know that's sort of, Anyways, all right. However, where was I? However, financial analyst Peter Schiff warns that a bullish stock market does not equate to a healthy economy. Significant issues, including record budget deficits, a struggling manufacturing sector, and an unstable commercial real estate market, persist regardless of who wins. While Trump has pledged to eliminate income taxes in favor of tariffs, Schiff points out that the U.S. lacks sufficient manufacturing capacity to support such a shift, calling instead for massive deregulation to revitalize domestic production. Internationally, Japan faces its own economic challenges. Prime Minister Fumio Kishida's change in stance on interest rates has revived the yen carry trade briefly, though Japan's central bank remains uncertain on future policy moves. Meanwhile, U.S. mortgage rates remain high, influenced by rising Treasury yields and persistent inflation, which the Fed rate cuts seem unable to curb effectively. While with the Fed increasing the money supply and inflation on the rise, consumers are expected to feel more financial strain in the coming years. The current trajectory hints at a decline in the dollar's purchasing power, which we've already seen quite a bit of, reminiscent of the inflationary lag seen in the 1970s. Both candidates' economic promises fall short of addressing the systemic issues, leaving the U.S. economy on an increasingly precarious path. Yeah, we're headed towards financial ruin if it just doesn't fall apart. Or, again, if we had smart people in Washington, they would, probably be proactive and try to pay off the debt or come to a resolution where we, deregulate a lot of things that are unnecessary or could be handled at the state levels. But, it's America and we're too lazy to actually do that sort of stuff. So we'll just wait till things get really bad and then we'll try and put Band-Aids on the problem. So. All right, well, that's everything they have for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there, so feel free to give me a call. I'd be happy to help. All right, well, that's everything that I had for the week, and I hope everyone has a fantastical weekend out there. I'll talk to you next time. Adios.